Most people still think the housing market is a price story. It is not, it is a liquidity story. That mistake is going to cost people a fortune, because when a market changes from a price story to a liquidity story, the winners change, the losers change, and the behavior that looked intelligent in the last cycle starts looking reckless very quickly. For years, people believed the housing market only moved one way: buy now or be priced out forever, stretch now or regret it forever, use the equity, refinance the equity, borrow against the equity, because the house will keep climbing and the next buyer will always show up with a bigger bid. That was the belief. But markets do not live on belief, they live on bids. And in 2026, the housing market is entering a different kind of auction. The bid is getting weaker, the seller may be getting more desperate, and the people who still think this is the same game it was in 2020 are going to discover that they were never really buying certainty. They were renting confidence from cheap money. I want you to understand this clearly, because the shift happening now is not subtle. In 2020, a median house at roughly $328,000 with a 20% down payment and a 2.96% mortgage produced a monthly payment around $1,100. That same house at roughly $420,000 in 2026, financed at about 6.5%, produces a payment around $2,200. Same house, same walls, same kitchen, same roof. But the monthly burden is effectively doubled. Now look at what happened to income over that same period. Income rose, but it did not rise enough. The median income increase was around 22%. That means the price of the home went up, the financing cost of the home exploded, taxes and insurance rose with the higher property value, and the buyer did not come close to keeping up. That is the first thing people miss in a liquidity auction. The sticker price matters less than the monthly carrying burden. If the payment doubles and income does not, the real buyer pool shrinks, even if people still want homes. Desire is not a bid. A bid is payment capacity, and payment capacity has been damaged badly. That is why I keep saying this is not a price story. It is a liquidity story. For years, the American housing market trained people to look at the wrong number. They stared at the headline price of the house and ignored the operating reality of ownership. But when rates rise, the monthly payment becomes the true admission ticket. That is the first mechanism in this new market. And I call it payment compression. Payment compression is what happens when household income cannot expand fast enough to support the financing cost of the asset people are trying to buy. The asset does not need to collapse for this to matter. It only needs to become unaffordable for a larger share of potential buyers. That is enough, because once the buyer pool shrinks, the housing market stops being an upward escalator and starts becoming an auction with fewer paddles in the air. The second mechanism is even more important. I call it the rate lock cage. In every healthy market, affordability stress would normally pull prices down fairly quickly. If buyers cannot afford homes, sellers cut prices. That is how markets clear. But the housing market has been distorted by a special kind of paralysis. Millions of homeowners locked in mortgage rates around 2%, 3%, or something close to it. If they sell and move, they do not trade one house for another. They often trade a comfortable financing structure for a painful one, so they stay put. They do not want to give up a cheap loan to buy a more expensive house with a much more expensive mortgage. This traps supply. It means a lot of owners are economically married to their current financing, even if they have outgrown the house, even if they would like to move. Even if their life would normally push them into another property, they stay. And when they stay, supply remains tighter than it should be. That is one reason prices did not fall as much as many people expected when rates jumped. People kept waiting for lower rates to rescue affordability. That was the dream. The Federal Reserve would cut, mortgage rates would soften, monthly payments would ease, demand would come back, the market would breathe again. But a liquidity auction does not care about dreams. It cares about the next cash flow reality. And here is where the third mechanism arrives. I call it the inflation choke. If energy prices rise, transportation gets more expensive, food gets more expensive, business costs rise, and inflation pressure becomes harder to tame. When inflation pressure remains alive, the central bank loses room to cut rates aggressively. That is what makes the housing market so dangerous right now. Many participants were not underwritten on what rates are. They were emotionally underwritten on what rates might become. That is a fragile way to make decisions. People were not buying homes on present affordability. They were buying hope that the financing environment would get easier later. That is not investing. That is prayer with paperwork. If oil stays high and inflation remains sticky, the central bank does not get the easy off ramp everyone has been hoping for. And if rates stay elevated, the buyer who already had weak payment capacity does not suddenly come back stronger. He comes back tired, older, and more cautious. That is why I say this market is a liquidity test. It is testing how many buyers can still show up after financing, taxes, insurance, and basic life costs have all moved against them at the same time. Now, if that were the only issue, the market would simply remain sluggish. Painful, yes. Frozen, yes, but not necessarily dramatic. The reason I think people need to pay much closer attention is because of what is happening behind the curtain on Wall Street for years. Institutions helped change the housing auction. They did not just participate in the market, they altered the bid structure. When large institutions can buy homes at scale, access financing at favorable terms, and treat neighborhoods like portfolios, they do not behave like normal families. They behave like capital allocators. A family asks, "Can we afford this payment?" An institution asks, "Does this asset fit our return model?" That difference matters because once large pools of capital start bidding for the same inventory, especially in selected markets, the ordinary buyer is no longer just competing against another young couple. He is competing against a machine. That machine helped push the housing market higher in important segments. But machines do not have loyalty. They have mandates. And when the mandate changes, the bid disappears. This is the fourth mechanism, and I call it mandate reversal. A great many people still imagine institutional buyers as permanent supports underneath the market. They are not. They are temporary supports as long as the economics work. As long as rent growth, financing conditions, asset values, and portfolio strategy line up, the machine buys. But if those conditions shift, the same machine that supported prices can become a seller. That is the moment people are underestimating. The source material behind this story points to a serious pressure point in private credit. I want you to understand why that matters. After the 2008 crisis, banks faced heavier regulation. Capital is clever. When one pipe gets restricted, money finds another pipe. Private credit grew into one of those pipes. It operated like lending without being regulated like traditional banking. Money flowed into it because returns looked attractive. Investors were told they could earn far more than a sleepy bank account. Companies borrowed because the money was available. Everything looked clever while rates stayed manageable, and the borrowers kept performing. Then rates rose, and many of the borrowers, especially weaker businesses and software companies now facing AI disruption, started to crack. That is where the fifth mechanism appears. I call it hidden contagion. Most contagion does not look dangerous at first. It hides inside products that were sold as stable, inside funds that were sold as sophisticated, and inside assumptions that nobody bothered to stress, test because the good years made everyone lazy. When businesses start defaulting and private credit vehicles struggle, the problem is never limited to one spreadsheet. It spreads through investor expectations, redemption pressure, asset sales, and financing conditions. And if institutions with exposure to stress credit also hold significant real estate, the housing market can become a funding source for damage happening somewhere else. That is the point almost nobody on Main Street sees. A family usually sells a house because of life, marriage, divorce, a job, a relocation, death, a larger family, a smaller family. An institution may sell because something is broken in a completely different division of the balance sheet. The house is not the story. The liquidity need is the story. That is why this market can flip faster than people expect. It does not require millions of ordinary homeowners to panic. It only requires enough marginal supply from players who need cash more than they need the house. Once that happens, the housing auction changes. For years, many local markets behaved as if demand was a permanent force and supply was the rare thing. In 2026, that equation can reverse market by market. Fewer buyers can qualify. Existing owners are rate locked and cautious. Institutions may shift from net buyers to net sellers. Politics is becoming less friendly to large institutional ownership of single-family homes. And private credit stress can force liquidation behavior that has nothing to do with the charm of the property itself. That is how auctions flip, not with a Hollywood crash, with a thinning buyer pool and a thicker seller line. You need to understand something else here, because this is where human psychology becomes expensive. When people see a house value rising on paper, they treat that paper gain like money. It is not money. It is an opinion. It becomes money only when there is a buyer at your price, with financing at the moment you choose to sell. Until then, home equity is not cash. It is a number floating on top of a market structure that can change. This is the sixth mechanism, and I call it the equity mirage. People built lifestyles on the assumption that the house would keep rescuing them. A cash out refinance for the renovation, a home equity line for the car, another line for the vacation property, another draw because the house made money. Remember, the house did not make money. The market temporarily placed a higher opinion on your property. That is not the same thing. If values flatten or fall even modestly, a household that treated equity like an ATM can find itself in a very different position. A 10% decline does not sound dramatic after the gains many markets enjoyed, but if a family borrowed aggressively against a high appraisal, a modest decline can put them underwater or close enough that flexibility disappears. That is why I have always hated the idea of treating a home like a slot machine. A home can be a wonderful purchase. It can provide stability, emotional comfort, control over your living environment, and long-term forced saving. But those benefits do not transform it into a magical financial instrument. Your home is a consumption asset first. A rental property is an investment asset. People who blur those two categories almost always get themselves into trouble when the cycle changes. That is the identity flip I want for you. I do not want you thinking like a bidder intoxicated by lifestyle marketing. I want you thinking like an underwriter of liquidity that is a completely different identity. The emotional bidder asks, do I love the house? The liquidity underwriter asks, can I survive the payment, the taxes, the insurance, the repairs, and a bad cycle without becoming forced to sell? The emotional bidder asks, what if it keeps going up? The liquidity underwriter asks, what if rates stay high? The economy weakens, and I need to hold for a decade. The emotional bidder sees rising equity and spends against it. The liquidity underwriter sees paper value and refuses to monetize fantasy. The emotional bidder treats low down payment leverage like a shortcut. The liquidity underwriter treats margin of safety like oxygen. That identity flip is worth a fortune, because once you become a liquidity underwriter, you stop making the kind of housing decisions that look exciting in a boom and devastating in a squeeze. Now, let me show you how I would build a housing operating system for this environment. I would start with the payment, not the price. I would never begin with, how much house can I get approved for? That is one of the dumbest questions in personal finance. Approval is not safety. Approval is sales capacity. A lender is telling you how much debt they are willing to place on your shoulders, not how much peace your life can support. I would begin with one question only. What monthly carrying cost can I handle comfortably if rates stay high longer than expected, and if some part of my income becomes less reliable? That means principal, interest, taxes, insurance, maintenance, and a reserve for the ugly surprises that every property eventually delivers. If the property only works under perfect conditions, it does not work. Second, I would separate shelter decisions from investment decisions. If I am buying a primary residence, I want emotional utility. But I never want to confuse emotional utility with superior financial return that keeps me honest. It stops me from stretching into nonsense. because I tell myself a bedtime story about appreciation. If I am buying an investment property, I care about cash flow, expense resilience, tenant quality, local supply, and neighborhood durability. That is a different underwriting process entirely. Third, I would study local institutional exposure. Real estate is never one national market. It is a patchwork of regional auctions. Some areas are more exposed to institutional ownership, more exposed to speculative building, more exposed to weak wage support, or more exposed to supply coming back online. Other markets are much tighter, less financialized, and more stable. A good investor does not talk about housing in the abstract. He talks about a zip code, a street, a school district, a landlord base, a job engine, and the local ratio between rent and ownership costs. That is where the truth lives. Fourth, I would stay allergic to no money, down fantasies. I have watched too many people confuse access to leverage with mastery of leverage. Those are not the same thing. Easy debt turns amateurs into heroes right before it turns them into cautionary tales. A property with no room for error is not an investment. It is a hostage situation wearing a smile. Fifth, I would keep liquidity outside the property. This is what many people refuse to do because they want every dollar working, every dollar optimized, every dollar squeezed. That mentality works wonderfully until life becomes inconvenient. Then the person with no cash buffer becomes a motivated seller. The market never punishes the man with patience and cash the way it punishes the man with optimism and no reserves. 6. If I were a buyer waiting for opportunity, I would stop worshiping the perfect bottom. I do not need the exact bottom. I need favorable odds. If the buyer pool is thinning, if institutional support is weakening, if the local supply picture is improving, and if I can buy with strong liquidity and a long holding horizon, I do not need a newspaper to declare the bottom before I act. What I need is a margin of safety. People lose fortunes waiting for certainty. The market charges extra for certainty. What matters is not buying at the lowest print. What matters is avoiding a price and financing structure that leaves you vulnerable. 7th, if I were already a homeowner, I would stop staring at online valuation estimates as if they were retirement plans. I would look at my cash position, my fixed obligations, my refinancing assumptions, my exposure to variable debt, my ability to hold the property through stress. Your house is not making you safe just because a website gives you a flattering number. Your structure makes you safe, your reserves make you safe, your fixed payment makes you safe, your discipline makes you safe. The number on the screen does not. And if I were an investor looking for the bigger lesson here, I would remember something very simple. Housing is one of the great mirrors in the economy. It reflects wages, rates, lending standards, energy costs, psychology, political incentives, and capital flows all at once. That is why this moment matters. The housing market is not flipping because one statistic moved. It is flipping because several systems are colliding at the same time. Affordability is broken. Rate cuts are less certain than people hoped. Private credit is under pressure. Institutional behavior is changing. And the old assumption that every weakness will be cushioned by abundant cheap money looks much less reliable. That does not mean every market crashes. It does not mean every house becomes cheap overnight. It does not mean homeowners should panic. What it means is more important. It means the era of effortless housing certainty is ending. And once certainty leaves a market, negotiation comes back, discipline comes back, patience comes back, selectivity comes back. That is good news for serious people. For years, serious buyers were punished by the market. The cautious person lost bidding wars. The disciplined person watched speculative buyers leapfrog him. The man who respected cash flow looked old-fashioned, while the man who respected hype looked brilliant. That is how every distorted cycle behaves near the end. It humiliates discipline before it rewards it. I have seen this pattern my whole life. It happens in stocks, it happens in businesses, it happens in credit, and it happens in real estate. At the top, people think prudence is weakness at the turn. They discover prudence was the only real strength. So here is the contract I would ask you to sign with your future self. I will not confuse approval with affordability. I will not confuse paper equity with spendable wealth. I will not confuse my home with my retirement account. I will not build a lifestyle on the assumption that refinancing will always rescue me. I will not buy because I am afraid other people will buy first. I will underwrite my life for a hard cycle, not a pleasant headline that contract is worth more than a lower mortgage rate, because if you follow it, you become almost impossible to bully. The market can stay high, the market can fall, rates can move, institutions can dump inventory, the news can scream, but you will still be standing there with the one thing that matters most in a liquidity auction choice, and that is what wealth really gives you, not the right to show off, not the right to imagine yourself rich because an asset went up on paper, the right to choose, the right to wait, the right to say no, the right to buy only when the structure makes sense, the right to hold without panic because you did not build your life on leverage and hope. That is the final test of this housing market, not whether prices tick down in some quarter, not whether a commentator gets to say he called it. The real test is much more personal. When the auction changes, will you still behave like an emotional bidder from the last cycle, or will you become the liquidity underwriter this cycle rewards? One of those identities will spend the next decade repairing a mistake. The other will quietly use the flip to build a much stronger life.